Pleased to welcome you to Elysium Wealth's Economic and Market Outlook webcast. I'm Lynn Todd Dorsey, President of Elysium Wealth. I'm proud to share that Elysium Wealth celebrated its one-year anniversary recently, and we are deeply grateful to everyone who has supported us throughout the first year. It has been a privilege to work with incredible clients, and we are truly excited to begin our second year working on behalf of clients who have entrusted us with their wealth and financial planning needs. Our goal this afternoon is to shed light on the current market uncertainty and volatility, much of which has been sparked by the tariff announcements made by President Trump on April 2nd. Over the past 6 weeks, investors have been navigating significant changes, from shifts in trade policy to the Federal Reserve's ongoing challenge of balancing its dual mandate of maximizing employment while keeping inflation in check. Add in the looming questions around recession risks and evolving global trade dynamics, and it's clear we're in a period of heightened complexity. To help us unpack all of this, we brought together two industry experts who will provide their insights and perspective. First, I'm pleased to introduce Jeffrey Mortimer, Chief Investment Officer at Elysium Wealth. As CIO, Jeff leads the firm's investment strategy and brings a wealth of experience. Jeff will walk us through Elysium's current market outlook and explain how clients' portfolios are being positioned in response. But before we get to Jeff, we're excited to welcome our guest speaker, Dennis DeBuscher, President and founder of 22V, an independent research firm specializing in investment strategy, policy analysis, technical research, and economic forecasting. 22V is one of several outside resources that Elysium Wealth uses to shape our views. Dennis will kick things off by giving us an update on his firm's latest views and key market risk drivers. After Dennis's remarks, we will have some time for a few questions that we've been receiving from clients. Dennis, thank you for joining us today. Let's get started.
Great, Lynn, thank you so much. That was a very kind introduction. Everybody, I'm excited to do this. I'm going to pull up some slides, if that's okay, and hop right into it. So I'm going to start with the main focus, just to kind of set the table. The U.S. economy is in an unusually strong position to handle shocks. That'll be the first part of the presentation. But growth will slow over the next, meaning economic growth will slow over the next 8 to 12 months. Growth will slow because the Fed is going to offset the inflation risk that is still there, even though tariffs will be lower than expected, but still there, by guiding demand growth to somewhere below 2% to make sure that inflation and inflation expectations remain anchored. So recession probabilities are down significantly since we've moved away from tariff heavy to something more in line with, let's call it tariff tolerable. Because the economy is in a good position to handle shocks, our recession probability over the next 6 to 8 months is now pretty low. When I say low, call it the 15 to 20% range, assuming tariffs stay around these levels that are most recently announced. And then going forward, you still have a little bit of elevated recession risk, but mostly because the Fed will be guiding GDP growth lower to make sure that inflation remains around their 2% target. You're going to get 1 to 1.5% inflation on core inflation above what we're on what would normally be the case because of the tariffs that are expected to go in. That's much lower than the 3%, by the way, in addition, that was possible. So if you think we're running at 2.5% on core, add another 1% to that, and that's going to be your inflation rate. We're going to have to work through that. It should start to fall off very quickly, and then the Fed can adjust policy. But as we go through that inflationary period, the Fed will let financial conditions remain a little bit restrictive, guiding GDP growth lower, which has implications for asset prices. It lowers your total return on the S&P, likely. So expect roughly 5 to 8% higher from here through probably the midpoint of 2026. So 1 year forward. That should favor quality type stocks or earnings momentum and growth factors. So those are the type of stocks that you would want to own. Same type of stocks that have been working, by the way, for the last few years. It's a headwind for small caps, value, deeper cyclicals, particularly energy and materials, for the time being over the next year, as long as the Fed is guiding GDP growth down towards closer to 1% to make sure that inflation risk stays relatively muted. The more economically sensitive sectors tend to lag. It's something we've seen, obviously, for the last few years, but kind of more of the same on that side. That being said, near-term recession odds have collapsed. So you do have a little bit of a counter move in small caps, value, and deeper cyclicals because they so significantly underperformed. So you have some resetting higher in those valuations short term. That's not something we would chase, given my previous comments. But the way the old tariffs, or the 145% on China, if you want to put it that way, those tariffs, the way they were being implemented or designed, was really, really a problem for small and medium-sized businesses, anything economically sensitive. Over the course of April, when the market rallied, the most economically sensitive stocks significantly underperformed. Their valuation spreads were anywhere. So you take a small cap valuation relative to the S&P 500 as an example, you got down to the first percentile. So you have some room to adjust higher, and that's happening. But once you've seen that adjustment in small cap multiples on a relative basis, roughly to the 25th percentile, I would imagine. So higher from here, but not much more so. You're going to want to go back to the same old things that have been winning, which is more your S&P 100 names, mega cap names, the monopolistic companies that can return a lot of cash to shareholders. Your growth and momentum factors will do a little bit better. Okay, so that's the setup. Let's go through some charts in data, just to that I'm not at least just pretending to make things up. Coming into the shock, and we saw this again today, inflation on a core basis had been acting a lot better than expected. So I made the point that inflation is going to be roughly 1% higher than on a go-forward basis, so additional 1% to where we start from, and the starting point is shifted down. So that's good news. It doesn't mean the Fed can cut, but it does mean that they can be a little bit less restrictive if your starting point of inflation is lower and the inflation risk from tariff is lower. Right, so there's less reason for the Fed to be very restrictive now, which would increase recession risk meaningfully, kind of like that stagflationary shock that was talked about. So what I'm showing you on these charts is core PCE. The black line is what you want to focus on. On a 12-month basis, you've had, which is the Fed's metric, by the way, core personal consumption expenditures, or core inflation, has been trending in a relatively Fed-friendly way. I've mentioned many times that the U.S. economy is in an unusually strong position to handle a shock. I'll run through some charts there quickly. The blue line on this chart is household net worth as a percent of disposable income. It's inverted there. So that blue line going down is household net worth as a percent of disposable income going up. The black line is the savings rate. The U.S. economy is still plus 53-ish trillion in household net worth since January 2020. It's a massive move. That will encourage low savings rates, ... unless the unemployment rate goes significantly higher. I'll come back to that, but the odds that the unemployment rate goes significantly higher in the current tariff outlook are pretty low. So you shouldn't expect savings rates to go up, which is something that a lot of economists have called for, wrongly, by the way, savings rates to go up, which would lead to significantly less spending and then layoffs. The vast majority of net worth, by the way, I mean, stocks have been a big part of it, and everybody says that, it's the top 10 percentile, top 20th percentile. That's not true. The vast majority of the stock of household net worth is home prices, equity in your home, and that affects just at least the 50th percentile, even a little bit more. Most people have some, in the U.S., have some leverage, if you will, to home prices and household equity. So this is not just stocks going up equals higher net worth. There's a lot to do with homes, and the outlook for housing should be very stable, given that we are short, right? We are short housing relative to the demographics of the U.S. economy. The labor income proxy, right? So it's wages plus hours worked. The orange line on this chart has actually inflected higher. So your labor income proxy, so what people are taking home. Here's a tidbit, by the way, in case you care. Everyone focuses on wages. hours worked, the amount of hours you work in a week is really important, right? So wages plus hours worked on a real basis are running about 2.25. That should mean that spending in the consumption part of the economy should be roughly 2.25, assuming the savings rate doesn't change. So your labor income proxy is really healthy now, and I was shocked, by the way, coming out of the last payroll report that the labor income proxy was so strong, which is why we're confident that in the current tariff outlook, you shouldn't see just a sudden rise in the unemployment rate for the fun of it. If you have the most sensitive or the biggest part of the economy, which is services, consumer spending, roughly 70%, at a still very healthy level, companies are not just going to lay people off unless tariffs are really bad, unless the shock is so severe that they're forced to, and it appears that that shock is gone. So we shouldn't expect a very large increase in the unemployment rate. Spending on the consumer side should be relatively healthy. There's no reason for the savings rate to go up. And just keep in mind that the household financial balance, right, or the private sector is in surplus. These charts might be a little bit difficult to see for you, so I'll just explain it. I would say the first one, the top one, household sector financial balance as a percent of GDP is still running just under 6%. Going into 2000 and going into 2008, the household sector financial balance was negative, which is another way of saying households were over-levered. And the economy is in a very good position to absorb shocks when the household sector financial balance is positive. So we have strong income growth, a positive household sector financial balance. We are short housing in the U.S. The blue line on this chart is single-family housing starts. The orange line is single-family permits. The gray area, if you can see that there, is the cumulative housing shortage, according to the Harvard study on household demographic needs in the country. So we are short houses relative, as far as building is being concerned, relative to needs, which means that there's not a lot of downside risk to home prices or housing being a significant drag on the economy unless interest rates go up aggressively. And last but certainly not least, I'll focus you in on the right-hand chart here. Credit support to actual consumer spending has been about zero. So what I mean by credit support is mortgage equity withdrawal, which is a channel I'm sure everybody knows of, has been a massive drag because of interest rates. Consumer installment debt has flatlined. And so your credit support to the change in personal consumption expenditures has been negligible. And it was a significant drag last year, which is to say people are spending out of income. So interest rate shocks, economic shocks are less impactful if consumer spending has not been based on borrowing. All right, so that's all the reasons why we're in a very good position to handle shocks from an economy point of view. It does not mean, though, that we are absolutely going to avoid a recession. It does not mean that everything is hunky-dory. Tariffs will have an impact. It will be through the inflation channel. And what that means is that the Fed is going to guide demand growth lower. So what does that mean practically for the people here? It does mean that you have a little bit of higher volatility, like a VIX relative to history. We have been in a normal economic expansion. We classify economic regimes, 4 different basic regimes. So recession, which is contraction in GDP growth. You have growth regimes, which is just a normal economic growth. Would be above trend. You have normal regimes, which is most of the time, and then you have transitionary periods, which is in between, when data points very conflicting. Like it might go either way between a normal expansion and potentially into a recession. So the economic regime over the next year and a half, as the Fed is guiding demand growth lower, will make the economy look like and markets trade like we're more in a transitionary period for the economy. To be very clear, this doesn't mean that you actually go in a recession. It just means that, the data will be a little bit weaker because the Fed needs it to be weaker to make sure inflation stays in check. By definition, if you look at the history of transitionary regimes, your volatility is a little higher, right? So typically you would have volatility, and I'm just using easy things like the VIX here, would be more in like the 20-ish range in the type of environment that we're talking about. And in a 20 VIX type of backdrop with economic growth that's tilted a little bit to the downside, again, the Fed guiding it that way, that should favor your quality factors, that should favor your growth factors, that should say, when I say factors, quality type of stocks, your growth type of stocks, your earnings momentum type of names, they should benefit at the expense of the more economically cyclical stocks. Because what I'm saying is we have more economic volatility potentially, which leads into stock volatility. And higher economic volatility is not good for economically sensitive names because there is some potential that you have just very weak growth for a long period of time. Even if that's not our call, it's still a higher risk than normal. So your small caps and your value and your deeper cyclicals are more at risk, all things equal. So the risk premiums in those names go up relative to the other names I described. Again, quality, earnings momentum, and growth. At some point over the next year, you'll see that slowing in economic growth. Let's call it in 2026. You'll start to see the inflation numbers kind of come off very quickly. I'm assuming that the tariff impact on inflation is transitory, meaning it lasts for another 6 to 8 months, and then it falls off very quickly. And as that happens, you get Fed cuts that are fairly aggressive, and they're trying to boost economic growth. And those are the periods where you want to own small caps and value and deeper cyclicals when the Fed is your friend and they're trying to boost economic growth. But they're not really going to be your friend. They're not going to be so mean either. Sorry to use these technical terms. But the net result will be guiding demand growth a little bit lower over time. Correlations have been unusually high. What I'm showing you on this is just S&P 500, small and mid-cap correlations on a rolling 1 month and 6 month basis. You can see it's kind of outlier. This has everything to do with the fact that the trade war, if you will, or tariff shock was such a shock relative to expectations in history. So correlations coming down, that's a good thing. So volatility is not going to be nearly as high as it was. It's still going to be a little bit high. It's still going to be pretty high, as I said, which should lead to lower correlations and some differentiation in stocks, hence focus on growth versus value as an example versus just one big correlation trade, which is what we've seen. Just so you know, there is a negative correlation between mega cap, the MAGA 7, if you or Mega 7 or whatever it's called these days, versus the defensive names. So deeply negative. So what I mean by defensives, if you're going to own staples, if you're going to, like a Coca-Cola as an example, if you're going to own the pharma stocks, if you're going to own the very high dividend yielding stocks, you probably need a negative market to justify that. When I say on a relative basis versus the mega caps. So there's a deeply negative correlation. And when you tend to see the mega caps underperform significantly is when you have a very sharp down move in the market that tends to favor the higher dividend paying names. I like the higher dividend paying names. I just wouldn't think about them at the expense of mega necessarily, unless you're very confident that the market will go down. Just a point I wanted to make. And then interesting to me, at least, this is the MAG 7 next 12-month multiple, the blue line relative to the S&P 500 next 12-month multiple, X the mega caps. You've seen a contraction in that spread, which probably encourages some buying of these names, specifically from international investors. So I'm not against the idea that the dollar is going down over time. That's actually our call. I'm not against the idea that Europe and the rest of the world has a better risk-reward profile than it has. But do not expect these monopolies that have very strong earnings growth with extremely high cash returns to be for sale on a consistent basis when you have a multiple spread in those names relative to the S&P and some international names, stocks, by the way, that has contracted back to levels that we haven't seen since 2017, 2018. So just something to keep in mind, that I wouldn't be too overly confident that these names can trade or would see even more multiple compression in these names on a relative basis from here on. So I'll leave it there and see if there's any questions.
Dennis, thank you so much. Always insightful, and appreciate all the work.
Oh,
just a couple from my end that we're getting from clients. You've alluded to a little bit of the Federal Reserve and needing inflation, a bit lower in the near term and maybe turning more friendly in 2026. Could you talk about a path for interest rates from our Federal Reserve when they may cut rates? So maybe when the first cut comes and how they come from sort of on your perch as you sit here today?
Sure, I would say the first one is probably at earliest September, more like the October, November period. So you probably can get one, maybe two this year. Under our forecast is probably closer to one. Because our forecast is relatively bullish the economy. So it's still a positive outlook for stocks in the aggregate if the Fed is not cutting. I'm sorry, not cutting as much as people are hoping. And the reason is because you have less tariff risk, but a stronger economy. Right. So if the Fed is cutting less because the economy is stronger, it's not and they need to keep the economic growth in check. That does introduce some risk that they overdo it. I get all that. But given the ability of the U.S. economy to absorb shocks, you should just probably take the good here and say the economy has lower recession risk. It's strong, which means the Fed can't as aggressively ease. It more impacts the internals than it does the overall headline index. So just that point. So let's call it 1 to 2 times, probably closer to 1 this year. And then next year, I think you're looking at 3 or 4 because the inflation numbers should back off very quickly. You'll have about a year of running demand growth, a little bit of below trend, and I think you could pencil in 3 to 4 cuts next year. And I would argue that you front load them, meaning I shouldn't say argue that you front load them. I'm not making a recommendation for the Fed. I don't do that. I'm saying I think the Fed will end up front loading them because the inflation drop off will be very quickly. Will happen very quickly.
Wonderful. And so the same thing, the opposite side of that coin is the unemployment rate. And so you don't see, I'm hearing calls from other strategists of, 4.5%, 5% unemployment. Maybe that was under, tariff, under a taut tariff regime, but you don't see that either. You see job growth, you see unemployment rate, right? You see those remaining well-behaved as well as we progress through 25 and into 26.
Yes, absolutely. And I would say something that's not talked about enough, and it was to start the year, is that labor force growth is shrinking aggressively. Immigration, right? We were letting in 2 to 3 million at its peak, 3.5 million in a year. You're going to get 750,000 in immigration from green card and visa holders. So your labor force growth is significantly less, which means that the payroll number only needs to be 50 to 75,000 to keep the unemployment rate flat. So it's very hard in a non-recessionary scenario to get a meaningfully higher unemployment rate given labor force dynamics. And I think that's something that people have forgotten. Yes, in tariff heavy, unemployment rate's going up. Just nothing interesting to add there. But in under our forecast, I'm not worried about the unemployment rate. I wouldn't expect the unemployment rate to go up. I would worry about the unemployment rate going up, but different discussion.
Perfect. Before I let you go, let me ask one more if I could.
Mm-hmm.
And you touched upon in your presentation relative valuations between sort of the Mag 7 and the rest of the S&P 500, the other 493.
Yeah.
Talk to me about overall valuations in markets, however, not just relative, but do you think we can support, and you mentioned, 5 to 8% or so total return over the next, fiscal 12 months. But talk to me about valuation and why you're sort of still okay with it, even though we're probably at, 1 standard deviation above normal on the valuation level of the U.S. equities.
Yeah. So the simple math is, or the simple way I think about it is, if you look at the S&P on a discounted cash flow analysis basis, so not just a simple price to earnings multiple basis, on a discounted cash flow analysis, it is not expensive. It's not cheap, but it's not expensive. So to the extent that monopolies can keep on growing earnings at analyst estimates, which are, always, by the way, understate their earnings growth, and return cash to shareholders at the rate they have, which is apparently not supposed to happen in financial theory, but it's happening, then you can support a higher multiple because you have such high cash returns and the ability to grow earnings, which is a long-winded way of saying their return on invested capital is so high relative to their cost of capital that they can have the best of both worlds, returning lots of cash to shareholders and growing earnings. So as long as that exists, and maybe it won't exist going forward, you will have a higher than normal multiple in the market, which is why, and I'll leave the point here, equity investors are not idiots. I want to make that very clear. So we had a VIX go to 50 and 55 a month and a half ago, yet the next 12-month PE troughed somewhere in the 18 range. We had credit spreads go significantly wider. We had what happened in the treasury market. Now, is there really smart treasury investors and volatility investors and credit investors over here and a bunch of idiot equity people over here? I highly doubt it. I mean, in this world of cross-asset arbitration and quantitative investing. So I don't want to get too confident on the multiple. I would just say that I'm more worried about the E being so wrong and the S&P coming down, less about the dynamics that support monopolist companies than I am around the multiple. Because if you keep monopolies in place, the multiple's not coming down. That's the simplest way to think about it.
Thank you.
Yep.
Thanks, Dennis. That was incredible. Thank you for your insights and taking a lot of complexity and breaking it down for us. It was fantastic. Thank you for your time today. We hope that you'll join us again on a future call. We'd love to have you back.
Have a great one.
Thank you. Now we're going to turn it over to Jeffrey Mortimer, CIO of Elysium Wealth. Jeff?
Thank you, Lynn. Yes, always great to hear from Dennis. He and I have been friends for a long period of time, and it's always nice to touch base with him. I'll just pull up, have Joel quickly pull up the charts, and we can get into it from our end. Now, remember, Dennis is one of outside strategists that we rely upon to help us frame our own views, but these are our own views. He has wonderful peers that we also rely upon and really talk to them frequently about sort of what's going on in the world. So if we can go to the first chart would be great. He mentioned that there was slowing GDP growth in the first quarter of 2025. And I just wanted to put up this chart quickly and reiterate that it was really tariff driven. So when you do hear the headlines about negative GDP in Q1 and the recession is upon us, I want to debunk this here. This was companies front-end loading imported goods to get in front of the tariffs. That's all that they are doing in the way that GDP is calculated. You can see it here. There's multiple inputs to GDP, but the reason was the export-import was completely out of balance and you get a negative print. So please take that with a grain of salt. Let's go to the next page. Dennis touched upon this as well, but I wanted to bring this page to the forefront. This is consumer sentiment, and it goes back into the early 1970s. And we have seen consumers very pessimistic. Perhaps spending will be down, and a lot of it is tariff driven. But on the far right-hand side of the page, you can see the green diamond, very low, April of 2025, down at 52.2. We then wanted to give you a historical perspective of other times where consumer sentiment has been this low. And you can really see it's in the global financial crisis, right? It's back in the oil embargo of the late 70s, right? It's in 1990. This is Gulf War I. These are times in our history where, when you look back at them, they presented, as you can see, very interesting buying opportunities in equity markets. In other words, the seesaw, everybody's on the sell side of the seesaw. As Dennis mentioned, the VIX up around 55 to 60. And you can see the future returns on the S&P, most of them having 20% in front of them, a 20 handle in front of the returns. And so these things always get my attention. I'm a student of history, as many of you know, and I always look back to what can we learn from history and what perhaps happens in areas where the pessimism is so widespread. Let's go to the next page, please. Here we look at the same coin, but the other side of it. And these are known as breadth thrusts. And these are days in which up volume swamps down volume on the New York Stock Exchange. In other words, those stocks that are trading higher times the volume of shares traded in those stocks, divided by the shares that are trading lower times the volume in those stocks. And what you tend to get, to me, these are a marker of smart money coming into the market. Perhaps looking at the last chart, seeing tariffs come off, seeing incredible pessimism, and you get these thrusts in the marketplace. And many people say, well, that was a nice day. And I say, oh, it was a much more than that. It was perhaps a change in paradigm. And because you can see that these thrusts that are a day long, when you look at the markets a week, 2 weeks, a month, 2 months, 6 months, a year later, you see this page is primarily green. And if you look out 1 year, you tend to get numbers, if these are too small for people to read, these are in the plus 20s. There's a couple plus 40s. The minimum is a plus 7 1 year later. So when you take these two charts that I've shown you and sort of put them together on the same side, right, different sides of the same coin, you see a market which has potentially moved from peak tariff fear to, oh my gosh, this might get better. And you heard Dennis's comments on Federal Reserve and slowing growth, but you heard the underpinnings of all of these strong companies. And perhaps these two things are coming together, leading us to a market which might not be heroic going forward, but certainly better than a lot of people are currently thinking. Let's go to the next page, Joel, and look at, again, the same things. I just want to pick upon 1-day gains. This is data going back decades. And you also get, you see 4/9 of 25. In 1 day, we were up 9.5%. And again, we ranked 1-day returns, again, going back decades. And you'll see on the right-hand side of this page for 1, 3, and 5 years. So we're stretching not just 12 months out, but also 3 and 5 year out. And again, you see a lot of green on this page. As you get to 3 and 5 year, you see a lot of doubles, or at least up, 60 or 70% or so is typical under these 1 day where a paradigm shift or a thrust has taken place. One more page, please. These are winning streaks in the marketplace. And I'm harping on this to really show you that a change perhaps is underway. 6-day winning streaks in the S&P are quite rare. And here you see a bunch of dates, again, going back a few decades. And please look at colors here. If you can't look at, I'll read out some of these numbers. But again, as you look out 1, 3, 6, and even 12 months, you see the average return is upwards of 19% 12 months out, with nothing being in the red. So I just point out these last 3 pages to really talk about the thrust and what has happened in markets over the last few weeks. It's been incredibly powerful, and it's not something that is typically short-lived, but it instead is a smart money indication. Money has flooded back into this market. The smart money comes first, and then right, people pile on top of that smart money over the next 6, 12, 18, 24 months, typically, to prove that that smart money was in fact right. Next page, please, Joel. Drawdowns. I wanted to talk to you about drawdowns in these are calendar years. The numbers in red are the drawdown in that year, and the bar height is the return, the calendar return of that year on the S&P 500. So it shows you kind of the price you have to pay. Now, most of these bars, of course, are up above the horizontal line. Most of the time, the returns on the S&P are positive in calendar years. But even in those positive years, you see drawdown, right? You see drawdown, negative drawdown. Our drawdown this year was upwards of 19%. We sit now, again, we update these charts fairly frequently, but we are around the flat line now. Over the last couple of days, the S&P is up about 4 or 5%. So we sit around the flat line now for that gray bar year to date. So playing out like history says, drawdowns take place, but markets tend to recover. Sometimes in the calendar year, sometimes it takes a bit more, but this is the heartbeat of a market typically. Next page. Just one more look at markets, and this is what happens to markets after a 10% drawdown, hard stop, sort of end of story. So it's just, these are known as fan charts. What can happen from the drawdown that we saw in 2025? What tends to happen from here? You see most of the fan is above, right, where we sit after the 10% drawdown, which is another way of saying typically markets recover, in fairly short order. The lines that sink below the black line, the end of the black line, are really if recession happens. And that's why you saw me probing at Dennis for, please tell me what the odds are of recession. And you say, I think to quote him, it's dropped off a cliff. The odds of recession under tariff light have really dropped off a cliff. And so if recession is not to come, then again, this fan chart just shows, again, that markets should creep higher from here. Next page, please. Again, it really does depend on recession risk, and we will monitor that closely going forward. Certainly, to me, if we avoid recession, I think markets continue to march higher. Maybe not in a straight line, or maybe not, of course, at the pace that they've done over the recent past. But I think you really have a decent foundation now, both from a valuation perspective, right, and from an earnings perspective for markets to continue to push higher. Next page. Valuations, as I mentioned, I poked at Dennis on this one as well. If you look back now, this is the S&P 500, the forward PE, the forward price earnings multiple on the S&P 500, and you'll see that, yes, we are not cheap. We're still up above, we're one standard deviation above our 30-year average. But as Dennis mentioned, you do have very strong earnings, very strong margins, and you even have very strong tech firms, which are almost monopolistic. And so I don't think you can wait for markets to sort of come down to long-term average. I don't know if we'll be there for long periods of time. You'll see we've spent most of, the post-COVID era has been way above market average as companies have continued to make a lot of money. So anyway, more to come on that one, but definitely not cheap, just as Dennis said, but also not expensive given the power of some of these underlying firms. Next page, please. Credit spreads, he had mentioned they had moved out. This is Achida, or these are issues that happen in the credit markets, which are signaling of economic malaise. And so you see them blowing out here. We did reduce some exposure within client accounts in some of these credit areas because we were worried that tariff heavy would stay, but as tariff light has become kind of the modus operandi of markets going forward, these spreads have pulled back in. So again, not only is the equity market healed, but also the fixed income market has also healed. These are very nice things to see. Fixed income markets many times can be an early indication of warning, but that they have settled back in also presents a nice backdrop to us for decent risk assets, both in fixed income potentially and in equities going forward. Next page. We'll end, as we always do, with our current positioning within the portfolios, and I'll also talk a little bit about recent changes. We stand neutral equities here. So overall, if you are a 60-40 investor, we would recommend that you be at your 60-40 target, right? Don't be underweight, don't be fearful, but stay within your strategic mix here, because we think decent times are ahead for equity markets. We do have an overweight to US large cap and an overweight to US over international. Recent trades have been to put a little bit more international, a little bit more diversification within client portfolios, but it has not changed our overall structure within the equity portfolio. Within fixed income, we are neutral to the asset class and do like taxable and municipal fixed income bonds. We did underweight opportunistic fixed income, as I mentioned, just because of the fear within the economic backdrop. And we wanted our clients, we use opportunistic fixed income when the skies are clear. And when we saw them clouding up, we wanted to de-risk the portfolio a bit. Within alternatives, we also sit at neutrality. So we want people at their strategic mix. We do like long, short, and the power of managers who can both be long equities and short equities in sort of a trader's market. We do not like as much managed futures and commodities. We do like clients potentially to have exposure to gold and even silver potentially in the times ahead. And we also like, for clients that are able to give up liquidity, we continue to focus in like private equity and private credit, as we think that these ways provide both income to the portfolio as well as capital appreciation potential for clients, again, that are willing to give up that liquidity. Lynn, with that, I'll turn it back to you.
Thanks, Jeff. Appreciate all those comments. I just have a couple of questions, perhaps before we wrap up. You talked about the thrust off the bottom and that the markets have propelled themselves back to where we were at the beginning of the year. and you are cautiously optimistic going forward. What variables will you be looking at as signposts that your outlook is playing out as you expect?
Oh, wonderful question. It's always important to have a vision and then to know what will be playing out. I'll look at three variables really. To me, inflation, right? A nice print today allows the Fed to continue to be patient, mindful, but also gives them room to cut rates if needed going forward. So inflation to me is number one. Next one to me was another question I asked Dennis, which is the unemployment rate. I want to make sure that the jobs market continues to be healthy going forward. A ratchet up in the unemployment rate is a foreshadower of recession. And so we have to keep a very close eye the first Friday of every month on what the unemployment rate is. Dennis brought up a wonderful point about our labor pool continues to shrink, which does allow potentially for lower unemployment rate going forward, sort of all else equal. And the last thing I'm going to look at are the markets themselves. I'm going to continue to keep a look on credit spreads, as I mentioned, and I'm going to continue to take a look at how the S&P is performing in the Mag 7, the S&P 100, those types of things. So I want those three pieces of the puzzle to continue to behave. And I think if we continue to get those, it will be those are the signposts that I'm looking for that we're well on our way to a good recommendation for our clients, and that there's sort of no need to fear. We're paid worriers for our clients, but that we're on the right path to sort of continued decent equity and fixed income returns as we play out.
All right, thanks, Jeff. Appreciate that and for your perspective on the markets today and how we're thinking about our clients' portfolios. And for our clients that are listening, if you have any questions about your portfolio or questions about the market that we didn't cover today, please reach out to us, to your wealth manager, and we'll get those questions to Jeff and just get any lingering questions that you might have answered. So on behalf of my colleagues at Elysium Wealth, have a nice afternoon and thank you for listening.